Hey, students, friends, family from around the world. Hope you're doing absolutely phenomenal. It is, of course, Jeremy Alexander Newsome with Real Life Trading. Hope you're doing phenomenal. Thanks so much for watching this video. Either you're watching it live with me right now, or you're watching it from YouTube, maybe Twitter, maybe Facebook, LinkedIn, a blog, an article, wherever you found the video. Thank you so much for showing up. This is, of course, first class in the mastery section, Master of Trading. Earn your mastery here. So realistically, ladies and gentlemen, this particular section is going to have 4 videos initially, but we're going to continue to add to this section of videos as my introduction video stated, because when we're mastering something, we're always continuing to grow and to adapt and to learn new things. These sections right here really are the epitome and the basics of what you need to learn and understand in order to become a real-life professional trader. Keep it simple, keep it easy, keep it focused, because remember, if you can't do the small, simple, easy things correctly, you're going to find a very difficult time adapting to the more advanced things correctly. So you really got to get that foundation, if you will, to understand on how the entire process works from point A to point B, and how you can take simple, easy steps from beginning to end so that you can also master trading. So in today's section, what we're going to discuss are options. Now, again, I'm going to make this as clear and easy as possible, and I'm just going to discuss what an option is. Options, as I mentioned in a previous class, were designed as insurance. They were designed as insurance for stock traders. Now, as you can think about insurance, you can really think about insurance and relate it to car insurance or homeowners insurance, or both, realistically. Probably more like homeowners insurance, but we'll talk a little bit more about it. So let's take a look at JCPenney for the moment, and let's ask some questions about JCPenney. So as of today, ladies and gentlemen, JCPenney is going down quite strong with some really good volume. Let's ask a question and see if you can remember what type of candlestick pattern would this be right there in pink. Do you guys remember that one? That is indeed a rest after battle, yeah. 2 white candles in the middle of 2 black candles. Now, I can agree that this candle did in fact close above the high of that candle in red, but realistically, it's close enough. We get an idea of the sentiment there. Now, this candle, you guys are fully aware of at this point. You have the new black crow candle. That is the black candle that opens and closes below the prior day white candle's close. We also have a really almost textbook falling 3 pattern right here on JCPenney. So what you have is you have 2 black candles, and in the middle of those 2 black candles, 3 smaller white sideways indecision type of candles, and obviously the trade continues lower. So how does this relate to options? Well, imagine if you were a trader and you notice, all right, well, you're looking at JCPenney and you're saying to yourself, I see some resistance right here. So your resistance you began to draw is approximately right about there on JCPenney. Now, why would you draw that resistance? Well, you have a peak right here where the stock stopped. You have some action right about here where the stock stopped. You have some resistance right here where also the stock did in fact stop. That's a pretty good resistance. Now, let's notice that we are indeed making higher lows. So we have a low here, we have a low here. Do you guys remember this chart pattern? We talked about this chart pattern in section 2. That's a double bottom right there. Very nice. And the double bottom pattern, right, we continued higher and we gapped. Now, let's talk about the type of gap that we created. Again, all from section 2. So we had a prior day's white candle. We gapped up. Ladies and gentlemen, would you wait for a retest on that gap, yes or no? And the answer is, of course, yes. Yes, you would. Why? Because the prior candle had a lot of buying pressure. We can tell that from the volume and, of course, from the long lower shadow and, of course, the white candle. So when it gapped up that day, you would have known to wait for a retest, which was phenomenal because the stock opened and did actually pull back a little bit, and you could have bought it lower, and or you could have had the opportunity of buying it the next day or one of the other 2 days when it pulled back. Or if you waited for a longer term entry, you could have bought it again back in here when it retested the gap. So how phenomenal, right? White candle that opened and closed above the prior day black candle's close, entry, stop, target, boom. Very nice 2 to 3 hour trade. Now, From here, you have a resistance on JCPenney. Let's say that you were like, wow, this looks like a great trade. It looks like we have a nice white candle that closes above resistance. Now, based on this particular candle and based on the gap, ladies and gentlemen, let me zoom in here for a moment. Again, what type of gap would this have been? Would this have been a retest gap from here to here? And the answer is yes, right? You have a white candle, stock gapped up. All those buyers are going to start selling at some point, and they did. Here's the selling began. So we did get a little bit of a retest at that moment. So if you bought on that breakout candle, you probably had a really good inclination that we were going to retest, which we did. So we retest, and we had a phenomenal gap right there. Ladies and gentlemen, did that gap trap people, yes or no? And the answer is, of course, yes, it did. Anyone who went short on this day and anyone who went short on this day, they are automatically trapped at the open of the next day. Specifically, if they went short below, the red line, that's where the stock opened. So they were trapped. They were losing money, so they were forced to buy to close. So as the stock continues higher, we get a little bit of a pattern like this, right? Some higher lows and some relative highs. Then we broke down. So let's just talk about this. Let's say, for example, you were a stock owner on JCPenney and let's say you bought 1,000 shares. You bought 1,000 shares of JCPenney at approximately $10.20, and you spent $10,200. Okay, you guys follow me so far? So you spent $10,200. Now, this trade, as it continued higher, we can see that we got into what phase of the market would this be? Yep, you guys are absolutely right. This would be the distribution phase. So we started distributing up here. And let's say you own shares, and right about here you thought to yourself, it looks like we are breaking down out of that distribution phase, and we could begin to get into a public participation phase. Now, maybe you didn't think that for sure. Maybe you thought, all right, well, here is old resistance, new support. So maybe you thought we're going to do this, and we were going to bounce, right? That makes total sense. Could have happened. But it started becoming more clear to you that once you saw this candle right there, which is a new black crow, right? A black candle that opens and closes below the prior day's close, you felt maybe this would go a little bit more bearish. So you want to protect yourself. How could you protect yourself and protect your stock position of your 1,000 shares? Well, there is something out there, ladies and gentlemen, called a put option. And put options, they go up when the market goes down. It's actually quite interesting, right? A put option, in its core value, what it is, it's a right to sell something at a specific price. So a put option is the right to sell something at a specific price. So what that means is if you bought the stock back here at $10.20, okay, and the stock was trading, and you notice, oh man, this looks a little bit more bearish than bullish, I'm going to buy a put option. And you buy a put option, let's say at $10.50. That would be called the strike price. Strike prices are predetermined for you. They do not change once you buy them. Okay, so let's say you buy the $10.50 strike price. What you're telling the market is you're saying, all right, I want the right to sell at $10.50. So just in case the stock goes lower, I have the ability to sell for higher. That makes sense, right, ladies and gentlemen? So what would you rather do? Would you rather sell something at $100 or would you rather sell something at $300? And obviously the answer is $300. You always want to sell at the higher number. That's why put options go up when the market goes down. You have the ability to sell something at a higher price rather than selling it back here. So if you bought a put option at $10.50 and your original cost basis was $10.20, here we go. Oops, I'm sorry, $10.50. What is your maximum risk on that trade? What is your risk on the trade? So if you bought the stock at $10.20 and then you bought insurance, you bought a put option, which works as insurance for your long position, your maximum risk would actually theoretically be a plus 30-cent profit. Fascinating, right? So when you buy a put option, what's the best location to buy put options, truthfully, when you own shares, is when the stock has positive equity in the position. So what that means, ladies and gentlemen, is since you bought at 1020 and the stock was going higher and higher and higher, you had the opportunity to simply buy a put at 1050, which is higher than what you bought the stock at 1020, therefore offsetting and really mitigating your losses quite well. So if the stock did go down quite significantly, then the insurance would mitigate and protect you. Now, just like homeowners insurance, think about this exact strategy and thought process like homeowners. Homeowners insurance, right? When you buy a home, let's say you spend, I don't know, $750,000 on your home. Okay, so I'm just kind of giving you an idea. So this is your $750 stock value. So let's say that you spend $750,000 on your home. And this is your home value, right? People want their home value to increase. That's why we buy houses. I mean, we either buy houses to rent them out, to live in, and or we want the values to increase in our home. But what is something that we buy and we pay for every single year just in case something bad happens to protect ourselves? And that answer is insurance, right? We buy homeowners insurance every single month, right? We pay money. And every year when our home doesn't burn down, thankfully, and nothing bad happens, we don't go out screaming to the wind that our home didn't burn down and you're really upset that you spent that much money on insurance. No, that's not the case because your home value increased. Well, that's what your hope and your intention is for stocks that you buy. You want them to continue higher. But just in case they do not continue higher, you have the opportunity to buy put options as a protection. Now, this was the exact trade that I personally did on JCPenney, right? Bought back here and then bought a put option right there. The put option that I purchased cost me 78 cents per contract. Okay? Each option contract controls 100 shares of stocks. So, ladies and gentlemen, if I bought 1,000 shares and each contract of an option controls 100 shares, how many contracts did I have to buy at minimum to protect myself? And the answer is, at minimum, I had to buy 10 put contracts. And I'll be showing you how to do that in just a moment, okay? 10 put contracts. Now, puts go up quite significantly when the market goes down. At the moment, those contracts are worth about $2.41. So I bought them at 78 cents. They're currently worth $2.41. So if we do the math on that, let's try to do that. I'm pretty slow at math. 241 minus 78. We've made a $1.63 profit on those put options. Now, just like your homeowner's insurance, the insurance that you buy isn't necessarily going to make you money, right? It's there to protect you just in case the worst case scenario happens, which is kind of what's happening on JCPenney right now. They're there to protect you. Right? So since I bought the stock back here at 1020, here's 1020, and right now the stock is worth about $8. That would represent a $2.20 per share loss. You guys follow me so far? So I bought the stock at 1020, and the stock currently is trading at $8. So that represents a $2.20 loss. However, I bought a put option, correct? So I bought a put option which increased in value $1.63. So if I just simply sold my insurance, so I, for example, just sold it, I would bring in $1.63, and there I would actually be looking at, instead of a $2.20 loss, I will be looking at, now I got to do some math for you guys. I can do that really quick, though. 40 is 60 minus 3, 57 cents. So I'll be looking at a 57-cent per share loss if I just went out and sold my position right now. However, you have the option, right? If you're looking at the value is $2.41. Okay, this is where it becomes fun. If If you exit both the shares and the option at the same time, as of right now, since they are valued at $2.41, instead of a $220 loss, you're actually looking at $2.41. You're looking at a 21-cent gain. So I know I have a lot of numbers on the screen right now. And bottom line, ladies and gentlemen, the reason that you have the 21 cents is because we bought the option back here at 10.50, remember? So we bought it at 10.50. So at 10.50 is the value of the insurance that we bought. We bought the shares at 10.20. So that represents a 30-cent profit if you went out and just let the insurance do its thing. So you've locked in your losses on that trade. Let me show you a very easy way to go and look and find put options. So let me go over here and I'm going to hop into Apple really quick. Now, this is simply Yahoo Finance. It's a free website. I'm not affiliated with them yet. Hopefully I get to have my big head on their website one day. But let's say, again, that we're hopping over to Yahoo Finance. Nothing special. Just go in Yahoo Finance. Then click on Options. Notice right there, Options. And you'll see that the first options that come up are going to be call options. Now, we're going to discuss call options in just one moment. But you have call options, and then if you scroll down, you have keep scrolling, you'll have put options. And these are the little guys that you can buy to protect yourself if the stock is going down. So let's hop back over here. And since we were looking at JCPenney, let's just go look at JCPenney so you guys can see how much that option is currently worth. So I'm going to click on options, and I had the October expiration 10.50 puts. Here they are, 10.50, and you can see that these options are, if you go out and sell them, they're worth about $2.41, as I mentioned, okay? So put options are something that you buy if you want to protect yourself in the case of a stock going down. Let's log into a broker to just kind of show you how that works and then answer some questions. Logging into a broker, and I'm going to pull up my virtual trading account in Options Express. I don't really have a real account in Options Express. My real trading is through Interactive Brokers. But if we come in here to Options Express, you guys will be able to see how put options look. Now, there's going to be a lot of information on the screen, but I'll hopefully be able to break it down for you guys. So I'm going to go to my positions. So let's talk about what a put option looks like when you buy them. Okay, when you buy them. So let me come in here, and I'll try to find one. Sold that one. Okay. Well, here's an example. It's not a very good example, but it is an example. On Facebook, for example, you'll notice right here, this is a position on Facebook. And on Facebook, I bought the $74 put. $74 put, as you can read that. Now, let's just ask ourselves and talk about intrinsically, what exactly does that mean? What does that mean? Well, what it means is that if we look at a Facebook chart, I am protected at 74. I have the right to sell my shares at $74. So if I come over to here, give me one moment, and let's hop over to a Facebook chart. Here we go. Facebook chart. So notice Facebook is not at 74. 74 is right here. So if Facebook did this, if Facebook did that, ladies and gentlemen, I'd have the opportunity and the right to sell at 74 if I wanted to. Now, if Facebook does not go down and we continue to get this particular candle that we're looking at, that candle actually looks pretty bullish. So I at least protected myself and bought insurance. And yes, if you can hop back over to the Options Express chart, you'll see that right now on that put option that I bought, I'm losing $1,170. Okay? That looks like a bad thing, right? It looks like, man, that's a lot of money lost. Well, if you look over to my position on Facebook, I'm actually up $21,000. So spending a little bit of money every now and then to protect yourself is not a bad thing, right? Let's say I spent $1,000 every month in protection, every single month in protection. and then over the course of 4 or 5 months, I make 30 grand in profit, but I spent 4 grand in insurance. Well, I'm still up $26,000 on the trade. So it's not necessarily, ladies and gentlemen, about making the most money. What the number one rule, as you guys remember, in trading is risk mitigation. Mitigate your risk. Don't blow out your losses. So if Facebook does just cataclysmically crumble over the next few days, I'm protected, right? I have the right to sell at 74. If Facebook continues to go higher, this option, right, the 74 option, this insurance, will expire. It'll expire worthless. So looking at that particular option, we have that understanding that put options, they make money when the market goes down because they are insurance for stock traders, right? People who buy stock, they are insurance buyers. Now let's talk about call options for a moment. Call options were created as insurance for people who sell short. Type in a 1, students who are live, if you do not know what selling short is. Type in a 1 for me. Well, selling short is how you make money when the market goes down. So let's take Facebook here, for example, and let's talk about this particular little pattern. It's a very, very small pattern called a head and shoulders. I don't really talk about that much because they're not that head and shoulders. Did I spell head right? It doesn't look like I'm spelling it right, but I think it is. Head and shoulders. We don't talk about it that much because they're not that common. But this is one right here, very, very tiny, tiny one on Facebook. Now, let's say that you wanted to go bearish and you wanted to make some money. Let me ask you a quick question, ladies and gentlemen. Do you and can you think of anything that makes money as the market goes down? Well, put options. We just talked about those. So you could have bought a put option to make money as the market goes down. So to answer some of your questions, ladies and gentlemen, you can buy put options without actually owning stock. They're just a tool. They're insurance. So literally, if you do not want to trade stocks, you don't have to. And hopefully that's a big aha for some of you, right? When you're trading, you do not have to trade the stock in order to trade options. You can trade options just purely by themselves. Now, remember my trading hierarchy, okay? Directional trading, that's what we're referring to right now, directional option trading. You guys will remember that it was the 4th highest on the list, and the red was day trading options. Well, directionally trading options, ladies and gentlemen, is the number 4 hardest thing to do in the equities market, in my opinion. And there's a time and a place to do it. So you could have, bought a put right here and sold a put right there and made a nice little profit. Or you could have sold short. The way you sell short is by going into your broker and selling to open the shares. So when you sell to open, you initiate a bearish trade. When you initiate the bearish trade, you are borrowing shares from the broker. So if you sell to open at 68 and the stock goes down to 58, okay, what is the difference in that figure, 68 to 58? The difference is $10. So remember the adage, buy low, sell high? Well, we're just totally flipping this around. In this situation, we're actually selling high and buying low. So again, as I mentioned in previous classes, if you sell something for $500 and then you turn around and you buy something else for $400, you have a profit left over. So if you sell shares for $68 and then you turn around and buy them back for $58, you have a $10 per share profit. So how much profit would you have if you went bearish 100 shares, ladies and gentlemen? 100 shares, how much profit would you have had? And the answer is $1,000. $1,000 profit because the stock went down, right? You sold to open. You sold the shares. You went bearish. So what a call option is, theoretically, is actually an insurance. It's insurance for people who sell short. So when people sell short, they want the market to go down. But as we know, markets generally go up. So selling short is often considered to be risky, even though it's not, right? If you know what you're doing and you know how to place your stops and you know about risk mitigation, it is not more risky than anything else. It's just really not risky. So if you understand proper risk mitigation, you understand how to control your risk, and you understand how to trade your plan, you can sell short. But selling short, you do, and it does require margin. You remember, as I talked about margin in class 3 of section 1, you need margin in order to sell stock short. So people who sell stocks, they were intending to mitigate their risk by buying a call option. Buying a call option, ladies and gentlemen, call options are quite simple. They go up when the stock goes up. So if the stock goes up, a call option will go up in value. It really is that simple. So let's say that you were short and you sold to open up here, but you did not buy to close yet. Okay, you were waiting. And the stock does this, and you begin to notice a little bit of a pattern like that. So higher lows, lower highs, and right here, you begin to say, looks like the stock might be continuing higher. It looks like it might break higher. So what could you do? You could either exit by buying to close, or you could simply buy a call option. So again, call options go up when the stock goes up. It's that simple. So they were created as insurance for the stock traders. Now, again, the majority of you out there will likely just simply trade the call option itself. You will buy the call, and as the stock goes up, you'll make money on the trade. Let's hop over to Apple, and I'll show you what a call option does on an option chain. So, ladies and gentlemen, let's answer a really simple question on Apple. Did Apple and is Apple going up today, yes or no? And the answer is, of course, yes. Apple is very much so going up today. All right, great. So, Apple is going up in value. Let's go and look at what would have happened if we would have bought a call option on Apple. Now, my rules for buying options directionally are as follows. Buy 1 to 2 strike prices in the money. Okay? Buy 3 months of time. 3 months of time minimum. And buy delta greater than 0.5. Those are my main rules. Another great rule is open interest is above 500. So for some of you, if you're a master of trading at this point, you probably have a really good understanding of what this information means. If it's totally brand new to you, it's absolutely fine. Like I mentioned, the videos that are on the site now, these are just the beginning of what's going to be shaping up. We're going to be continuously creating and updating and changing and improving and innovating the sites that are here. The videos that are here, making them better and better and better for you. But for now, this is a really solid piece of information for my newer students out there in the world. These are some solid strategies, right? 1 to strike prices in the money, 3 months of time, buy a delta, and do 500 open interest. So if we go to the options chain, ladies and gentlemen, can you remind me what type of option goes up when the stock goes up? You guys remember? Call options. Yes, call options go up. So if we buy at least 3 months of time today, how much time is that? Well, it's December and or January. These are the expiration dates. So just like milk, ladies and gentlemen, options, they do have an expiration date, just like your insurance policy. So if the insurance policy is about to expire, you need to understand that so that you know what to do with it. You either buy a new insurance policy or you renew it or you go get another company or whatever the case is, right? Okay, great. So let's say, for example, you buy 1 to 2 strike prices in the money. What does that mean? Well, on Yahoo Finance and most brokers, you will have a color code helping you to decide what actually is in the money. And on Yahoo Finance and also Options Express, in the money is colored yellow. Colored yellow. So an in-the-money option, ladies and gentlemen, is simply safer to trade. They're just easier and safer. They're affected by volatility less. And if you buy in the money, it is a safer route to go on, okay? So an in-the-money option, if you want to remember it, is simply an option strike price that is less than $100.76, a.k.a. it's an option that is less expensive than the current value of the stock. So, ladies and gentlemen, these are the strike prices right here. You can see here is the strike price. Think of these, if you will, almost like the deductible of your insurance policy. The deductible doesn't really change once you get into it. Now, you can obviously update it, just like you can update the strike price. But once you get into it, it doesn't really change that often. So what you're saying, ladies and gentlemen, on Apple is you're saying if you buy the 9750, you are literally purchasing the right to buy Apple at 9750. It's exactly what you're doing. You're buying an option, an insurance option that gives you the right to buy Apple at 9750. Now, in this particular scenario, remember just a few moments ago how I said you do not have to take possession of the stock when you're trading options. That is very, very true. Even though you have the right to buy Apple at 97.50, you do not have to buy Apple at 97.50. You can, if you want to, simply buy and then sell the option itself. So earlier this morning, if you bought the December 97.50 option, you would have spent $5.10. $5.10 per contract. So remember, each contract controls 100 shares. So ladies and gentlemen, how much did you spend on that purchase? And the answer is $510. That's how much you spent per contract. So what is the option worth right now? If we turned around and we sold it, what's the option worth? The option is worth $570. If you turn around and sold it right now. So you would actually have made, what is that? $60 profit minus commissions just today alone from that trade, which is pretty solid. I mean, that's a 10% return on your investment in one day. In one day. So yes, ladies and gentlemen, options have incredible leverage, and as I mentioned to you, you have to understand they are one of the more complex issues in trading. This is, again, just a really brief overview to kind of get your taste buds wet for the future, because in the next class, we're going to be talking about Elliott wave, and then we're going to get into Fibonacci. So there are some advanced techniques out there that you need to master, and of course I'm here so that you ask questions and you post questions on our Facebook page, so that way you can understand a little bit more about options. And of course, in the near future, I'll be re-releasing this video that you guys can watch live again, that we will be teaching, so that when you guys are here, the content will be fresh, it'll be updated, it'll be new, and it'll be more, a little bit more interactive with you guys in the live class as well. So, bottom line, ladies and gentlemen, call options. You really need to make sure you understand risk mitigation, how it works, how to buy, where to place your stops, how to get into the broker, and I will absolutely be explaining that to you in the near future for sure. So keep coming back to the websites, ladies and gentlemen. If you have any questions at all, of course, you're more than welcome to email me at jeremy@reallifetrading.com. Otherwise, ladies and gentlemen, thank you so much for watching this video. Go tell your friends, your family, your coworkers, anyone who wants to know a little bit more about options. This is a great morsel of information to start them off in their education process, and we'll be hopping them and getting them into some more detailed information in the near future. Ladies and gentlemen, thanks so much. You guys absolutely rock. I'll see you later, and until next class, love life, live life, trade it. Welcome to Real Life Trading.